Ladies and gentlemen, a round of applause for our panel here. Money Week. And it is so fantastic to see such a good audience here as part of the Money Week panel. We have on the panel, we've got Rob Everett, the CEO of the Financial Markets Authority. Rob, welcome. We have Mary Holm, columnist, author, seminar presenter, the FMA board member and director of the Banking Ombudsman Scheme. Mary, welcome to you too. We have John Boddy, managing director of ANZ Wealth. John, hello. And also we have Martin Hawes, authorised financial advisor, author and columnist. Welcome. I just want to ask you the simplest of questions, because this is really what it's all about, isn't it? And that is to you, Martin. What is risk?
Risk is the chance that you won't meet a particular objective. Now, one important thing comes out of that, and that is that you have to know what the objective is. Because how do you know what your risk is if you don't know where you're going? And I'd liken that to taking a journey. I do a lot of mountaineering, and if I don't know what the objective is, the summit of some worthless bit of rock or snow which is much higher, then how do I know what the risk is going to be to get there?
Why is it important for New Zealanders to understand risk in relation to investment?
Yeah, so much the same. So I think one of the key things about thinking about risk is, to Martin's point, what is it you're trying to do? It's a risk to what? What have you decided it is you want to do? What are you saving for? What are you investing for? Where are you trying to reach? And then you have to think through, how am I going to get there? And what are the various risks of each of the different routes that I might take to get to that point? So, yeah, much the same.
Here's a question for you. Which of these investments comes with a guarantee that you'll get all of your money back? We're going to play a game. Put the lolly in the jar of the investment that you think comes with a guarantee. We're at St Luke's Mall, and let's see what the people think. Do you want to play our game?
Sure. I'm going to choose KiwiSaver.
Bonds will come with some sort of guarantee. Term deposit will come with a guarantee.
Bonds.
Term deposit.
There you go. Put your lolly in the jar. What did you choose?
KiwiSaver, Super and term deposits.
Why did you choose those?
Because these are run by government. And term deposits, because we trust on banks.
We know that banks aren't great because governments have had to bail banks out before.
Tell me why you said bonds and why you said none.
Bonds because you just make sure you will get the same amount that you pay.
Do you know the answer?
Is the answer none?
Yeah.
As far as I'm aware, the government back up the banks for term deposits.
Keep going.
And the bonds, they're government issued. So if the government falls over, the whole world falls over.
Bonds and KiwiSaver.
And why have you chosen those ones?
Probably something that I've heard friends talking about.
Yep. None.
I don't think you can get all of your money back on any of them.
That's the answer.
Oh, thanks.
The results in a nutshell are only one person knows that there is no guarantee on any of those investments there on the table. KiwiSaver, people thought there was. Super and term deposits as well. Shares and bonds, not so much. Back to you, Wallace.
Sean, speaking of risk levels, is a more conservative fund the right fund for New Zealanders who don't make a choice?
Now, we believe that generally as a guiding principle, if you're a younger person, you're going to be in the market for 45 years, you join KiwiSaver at 20 with an aim to be there at 65, you need to be in a more balanced portfolio, or more probably start with a growth portfolio, then become relatively less aggressive as time goes on. Albeit if you're looking to buy your first home, you need to have that as an influence in your decision. The numbers we worked out is that the difference between being in a conservative portfolio all that 45 years versus being in a lifetimes approach where we gradually move you through a risk profile from growth through to balance when you start to need your money is about $90,000 to the average KiwiSaver investor. So it does make a difference. So we don't believe that the conservative is the right default. We think we should default into an age-appropriate asset allocation.
Just wanted to add a layer to what we've been discussing there about choice of KiwiSaver fund, and it also picks up on the conversation we were having about property, which is everyone needs to look at this in the round, right? So if you look at what your other investments are, what your other exposures are, that actually may have a significant impact on what is the right KiwiSaver fund for you, or even whether you should be in KiwiSaver fund at all. So a lot of what we're talking about in trying to encourage people to consider the risks to their goals in making their investments is looking at all the different pieces of the jigsaw that you've got and working out, well, if everything else I've got is very conservative, then maybe I can take a little bit of risk with this disposable income. If it's actually not really disposable income and you're actually going to need it for something, that will change again the way you're going to put it. So I think whether it's KiwiSaver, whether it's property, whether it's investing in equity markets, you have to look at your overall situation and work out how it all fits together.
Yeah, we're talking about investing and that type of thing, but shouldn't we actually pay off debt first?
Yeah, there's a basic rule that any spare money you get, whether it's capital or whether it's ongoing and whether it's a surplus of income over expenditure, any spare money you get should go to repay debt first. There's one or two exceptions with that, and the big one is KiwiSaver. And I am very happy for people who have mortgages or maybe who have other debts to go into KiwiSaver because the subsidies are so good that the returns, and that makes the returns so much better, that you are actually better to go into KiwiSaver even while you have a mortgage. But the general principle still stands. KiwiSaver is just the exception. General principle is you pay off debt first.
Mary, a question as well, Rob, for you. Given the damage, and we talked about this off air, didn't we, but given the damage to confidence caused by the finance company collapses, can investors be confident, can people here be confident that they'll not be ripped off?
Yeah, that's a good question. I mean, I'd start by saying you can never be sure that you're not going to be ripped off, so you should always spend time properly researching anything you put money into. The regulatory setup in New Zealand has been completely rewritten. It's been completely overhauled. The FMA, as the regulator, came out of that. The Financial Markets Conduct Act came out of that, which has, as it sounds, a significant focus on conduct, the behaviour of people offering financial products. And I think that's a really strong development.
Right, here's a question for you, or rather for the people on Queen Street in Auckland. We're going to ask them to look at a whole lot of financial products and tell us what level of risk you can associate with them. Is it low, is it medium, or is it high? Here you go, that's a term deposit.
It's low.
It's low, very good. Housing.
Medium.
Medium. That is obviously what it says. Share market. High. Term deposit at the bank.
Low risk? Bonds.
Low, medium or high risk?
I'm going to go with a medium.
Final answer?
Or maybe high.
Go with your gut. Okay. That's the share market, so stocks.
Generally pretty safe if you know what you're doing.
Yep, private equity investments, high risk. Chuck that there. The share market.
You mean New Zealand or?
Yeah, say, yeah, New Zealand equities.
Right now or just in general?
Yeah, in general.
High, middle to high.
Yep. KiwiSaver, low. As an investment, low, medium or high risk. And I'll tell you, there's actually no really right answer for this one.
Low risk?
Yeah, it depends on the time, place and that sort of thing. So very good. Finally, crowdfunding. So that's a new one that's come into the regime recently. Where would you put that? Equity crowdfunding.
Geez, you've got to say high, haven't you?
Very good. Property. If you can afford a house, what kind of
Tell me about it, eh? It's pretty low risk again if you know what you're doing. It's only, like, especially in Auckland, it's only going to, it's only going to go up, eh?
Cool. And finally, a term deposit at the old bank.
Low.
There you go.
Are they right answers?
Some of them were well, some of them were good. Some of them were good. Bonds.
Apart from Greek bonds, low. Not European bonds.
Okay, so there's the views from the street on these different investments. Back to you to discuss.
Rob, what about volatility? I mean, is that an issue when deciding how and where to put money?
Yeah,
volatility?
yeah, absolutely. So again, some of what we were talking about earlier about investing in property, investing in markets, one of the things that you want to assess when trying to judge the risk of an investment is the extent to which it goes up and down and over what sort of time horizons, because you have to map that against what it is you want at the end and when that end is going to occur. So volatility matters a huge amount because actually traditionally volatile investments can return a great deal, but they can also collapse at the very point you need it most. So I think looking at the volatility and working out how close to the point you are when you actually need your money back is absolutely critical. And being in a very volatile investment, and this might have been some of the commentary about Auckland property, very close to when you know you're going to need the money, it's not a great place to be because you've got no time to recover if it actually drops just before you need it. So yeah, absolutely, one of the factors you need to think about in deciding what your goals are and how much risk you're prepared to take is how volatile the different types of investments may be.
There's a question here, Mary. Off there you had a bit something to say about another piece of advice or research that the Financial Market Authority did, and that was how long people did their homework. Now, 50% said they would take a day or less to choose where to invest 10 grand. And 1 in 5 said it would take no longer than an hour. Now, is that a concern? People are not taking enough time to do their homework, as Rob suggested a bit earlier. What do you think?
No, I don't think it is a concern. It depends on if you've got a mortgage, for example, and you might be able to answer that in a flash. If you've got $10,000 or $100,000, an awfully good thing to do with it is to pay down the mortgage. And so the fact that I don't take a long time to think about that, it doesn't mean I'm not financially literate at all. It might mean the exact opposite.
Yeah, and I don't have a mortgage, but if I did have one, it would take me 5 seconds to know what to do with $10,000. That's to put off against the mortgage. I'm an investor as well as an advisor, and as an investor, I have an investment strategy. It wouldn't take me long to work out what to do with $10,000 because I have a strategy, a plan in front of me which would tell me what I needed to do about it. You know, it's got asset allocation set out, and I would just simply look at my asset allocation and see what was a bit lacking, and that's where the money would go.
But I think, Martin, you'd be an extreme case for most of us in that you're not only an advisor, but you've got enough money that $10,000 isn't going to transform your life. And to Mary's point, yes, if you've got a mortgage, it might be a simple question, but I actually disagree. I think for most people, that's a lot of money. Some of the questions were much bigger chunks of money. And one of the things we worry about as a regulator is there information out there that people can look at to help them make informed decisions? And can we encourage people to, in fact, do that and make informed decisions? I think there are circumstances in which it will be a no-brainer. I think there are circumstances that for some people it will be an easy decision. But actually, I think for most people, what you do with a sum of money that you weren't expecting or that you've invested and it's paid off, it is actually a complicated decision. There are a number of choices open to people, even if you just look at KiwiSaver, which is a different thing, but the number of choices are quite overwhelming for a lot of people. And so taking the time to do some research, thinking about getting financial advice and going to an expert who can actually talk you through the options, I think is time well spent.
If I was given 10 grand right now, I wouldn't know what to do with it, Neil.
You'd be in the casino, wouldn't you, Wallace?
Oh.
Yeah.
Yes, my question has to do with the conventional wisdom that if you've got 40 years before your retirement, you put it in growth. If you've got 10 years, you put it in conservative. My concern about that is if someone starts off with, say, 1,000, and they say, okay, I want the whole thing to go into shares, they might get a return, but the fees are going to be a huge amount. Wouldn't it make a little bit more sense for them to start off with conservative, and then when they've got like maybe 50,000, then put it in growth? Because yes, they'll pay fees, but the 50,000 multiplied by the interest will make it worth it.
Actually, a point that I would make, which I think responds partly to your question, is remember you don't have to put all of it in any type of fund, in that you can spread it across different types of funds, conservative growth within one provider. And your point is a fair one, which is everyone always assumes that over a long period the growth funds will return. But again, as we explained earlier, if you're unlucky and you're getting that investment mature at a very point when those markets are down, that may not work. So that's why the conventional wisdom is to go more conservative towards the end. But again, I made the point earlier, you have to blend everything you're doing in that space together to make sure that as a whole you've got a sensible investment picture. And that may mean that some element of what you invest is somewhat speculative and high risk or growth, and some of it is more conservative. And I think that's the way to look at it.
Yeah, I think also there is another layer in terms of the fee, your comment around fees. The evidence over the long-term history is based on after fees. So it's the after fees returns that are actually what matters to you as a saver. So the history has shown after fees returns in the more aggressive funds have been higher. And the second thing is, as an investor starting out, and you start out and you've got your first $1,000 invested, you're a net buyer or a net investor for quite a long time as you continue to drip feed into your KiwiSaver account. So even if the market does go a little bit lower at the start, it's not a bad thing for you in that it gives you an opportunity to buy your longer term investments at a better price.
Just on the back of your comment, a little bit about diversification. I mean, Mary, that classic cliche, don't put all your eggs in one basket. How important is that?
Awfully important. Well, yeah, one of the basic messages, and pretty much every KiwiSaver fund has got a nice spread like that. Having said that, if you're in, say, a high-risk KiwiSaver fund, it is still going to do what Rob refers to. It's still, the whole share market goes down and up again, and so on.
When it goes down, do you get worried or what?
Well, hopefully not. That's the worst thing to do, is to bail out when it's gone down, and unfortunately that's what a lot of people do. In KiwiSaver you can't bail right out, but you can move to a lower risk fund. So if you're going into a high risk fund and then it goes down, please don't bail out at that point, because it's the worst time to get out. So if you're going into a higher risk fund, you've got to promise yourself you're going to hang in there. One other just quick point, in addition to what Rob was saying before about when you get to retirement, you don't necessarily want all your investments to be at age 65 to be low risk, because these days we're living to 85, 90, 95. You want the money you're going to be spending in the next, say, roughly 10 years to be low risk, but money that you're going to be spending later on in retirement, you want to keep that in high risk and gradually move it down year by year.
The awkward reality is that the people that need to be sitting here and perhaps watching the show are not going to be. And those are my thoughts, and I thought, can you comment on that?
Yeah, well, we're preaching to the converted. I couldn't agree more. And it's very tempting to say that financial literacy needs to be taken into schools. And, I would love to see that, but with the caveat that that wouldn't be easy, because you're loading yet another subject onto the curriculum of teachers who may or may not know an awful lot about the subject, and to an audience being children for whom money may or may not have terribly much relevance.
It is true, but there's a couple of things. Like KiwiSaver is a great opportunity for children. You can enrol your children, they get the government grant, and you can start to explain to them when their KiwiSaver reports come in, what's happening to their investment, what they're invested in. So there's opportunities like that. But I do agree, there is a mountain to climb to get all New Zealanders with the right type of financial advice and the right financial plan. And I think it's the responsibility of us today to make a small step up that mountain, the media to help, us to give our time to the schools and education institutes and to just continually get it front of mind. And we will get there. We won't get there in 24 hours or 24 days, but every step, I think, is a positive step.
And really, it's a very good question, because all of you are obviously displaying interest in investment matters and investment risk. That's why you've come. But the overall purpose of Money Week is to reach beyond those who are already displaying interest and try and get some more people interested in understanding about money, about financial planning, about investments, about whichever piece of that is relevant for them.
Do you think that New Zealanders are buying, and maybe they should consider renting instead, starting off you buy and then you've got to put all your money towards paying off that debt. Is that something that we're missing?
There's nothing wrong with not owning a house as long as you reach retirement with enough money to pay your rent until you die. And that means several $100,000 probably. But having said that, that is a legitimate thing to do. And currently rents are low relative to house prices, so it's actually quite a good deal to rent. One more quick thing though, if you do want to own your own home, and there are a lot of psychological reasons rather than financial why people want to own their own home, and they're totally legitimate. By far the best way to do it is through KiwiSaver, because you're getting, you can put your money in and then you can also take out money the employers put in, take out, as of next April, most of the money the government's put in and all the returns, so you're going to get far more for your, even if you're not eligible for the subsidies. And if you get the subsidies as well, it's a terrific way to save for a first home.
If you try to do the numbers between owning and renting, and when you're renting, you're investing, obviously, they come out pretty square.
Yes.
It's a really difficult calculation to do because you're making a whole bunch of assumptions, and that's not easy. But they tend to come out pretty square. The one thing that home ownership really does have is discipline, because bank managers get really grumpy if you don't pay the mortgage. And by paying the mortgage, you're effectively building your net worth. So people often, when they're renting, get a signal that they're getting the house very cheaply and they can spend everything else. That's the wrong signal.
Final thoughts around the panel, 30 seconds. Is there any take-home message as part of Money Week? Something very simple that we can all take home with us tonight. Martin, you first.
One thing I suppose is the very first thing I do with any investment is to work out what your asset allocation is. That is to work out what type of investor you are, conservative, balanced or growth. That leads on to asset allocation, because all the research says that the greatest variation of investment return comparing one portfolio to another is about asset allocation. If you can get that right, you've got about 90% of the job done.
Right, John?
Yeah, mine would be try and be able to answer 3 questions. The first one is, how much money on top of the government superannuation do I want when I retire? So how much per week or per month? The second question is, to get that much every week and month, how much of a lump sum will I have to have when I retire? And to get that lump sum, how much do I have to start saving today and next week and the week after, and what type of fund to have a good chance of getting there?
All right, Mary, what about you?
Diversify, diversify, diversify. In terms of owning lots of different shares, for example, and lots of different bonds, but also owning some shares, some bonds, some property.
Diversify, diversify, diversify. And Rob, how about you?
Yeah, for any investment, how much of it can you afford to lose, and when do you need it back?
Very good. Hey, look, a round of applause for our panel here tonight. Rob Everett, Mary Holmes, John Body, Martin Hawes. A big thank you to the Financial Markets Authority, and thank you so much for coming out this evening. Really appreciate it. Thank you.
Thank you.